Welcome to the Deep Dive, where we take a stack of information and really try to distill it down to the essentials.
That's the goal.
Today, we're digging into an iconic American industrial giant, 3M company, ticker MMM.
Right.
You've probably got some of their products in your home right now, definitely. But understanding the full scope, the business, the challenges, it takes a bit more.
It really does. And our mission today is to sift through all this data. We've got analyses, even what customers and employees are saying, to give you a clear, concise picture of what 3M is, how it's positioned, and maybe, what its future looks like. We have a lot of interesting sources here.
Covering pretty much everything, right? Business model, financials?
Exactly.
Yeah.
Financial health, competitive standing, the whole 9 yards.
Okay, so let's start there. Let's unpack this business. We know 3M for things like Post-it notes, Scotch tape, but it's this vast science-based manufacturer. What's the core engine? What actually drives the revenue and profits?
Well, at its heart, 3M leverages this deep portfolio of over 40 distinct technology platforms. Things like adhesives, abrasives, films, non-woven materials.
Okay.
And they use those to create, get this, over 60,000 products. Revenue comes from selling these globally, sure, but also licensing long-term contracts.
60,000, wow.
Yeah. And what's really fascinating, I think, is how it functions like they call it a technology arbitrage engine.
Technology arbitrage. Okay, tell us more. What does that mean?
It's actually pretty brilliant. They develop a core technology, let's say a new adhesive, in one specific area.
Right.
And then they systematically adapt that same innovation across dozens of different, sometimes totally unrelated markets.
Huh? Like how?
Okay, so maybe in advance they make an industrial tapes that can inform how they make medical bandages.
Okay.
Which then might inspire consumer product like command strips. So this cross-pollination, it spreads the R&D costs over a much wider base.
Makes sense. Lowers the cost for each new product.
Exactly. Lowers incremental development costs and just speeds up getting new stuff out there.
So this interconnectedness, that's been a key feature for a long time. Our sources mention a really big recent event, though. The spin-off of their healthcare division.
Yes, into Solventum. That was April 2024.
Right, Solventum. How does spinning off such a huge piece change the remaining 3M?
It's a really significant shift. The company left behind is now organized into 3 segments. You've got safety and industrial, it's the biggest, about 45% of revenue.
Well.
Then transportation and electronics, about 34%, and consumer, the smallest, at 20%. So it's definitely more focused now on its B2B, its business-to-business segments. And the key question everyone's asking is, does this streamline the company, make it more focused? Or did it break a vital link in that synergistic chain, that whole technology arbitrage thing?
Yeah. Does it hurt the cross-pollination you mentioned?
Potentially. That's the debate.
So at a high level, the model is basically apply science, solve problems. Seems pretty straightforward. Does that basic idea still hold water today? Does it have staying power?
Oh, absolutely. I mean, these aren't fads 3M is selling. Their products are deeply embedded in fundamental industrial processes, consumer habits.
And people actually need.
Exactly. Adhesives, filtration media, safety equipment, they're essential. And the model lasts because it's adaptable, right? It's rooted in those technology platforms.
Can you give an example of that adaptability?
Sure. Look at electric vehicles. As the world pivots to EVs, 3M adapts its know-how to create new stuff for EV batteries components.
Okay.
That specific business line grew like 30% in both 2022 and 2023. So they're actively trying to align their innovation with these big global mega trends, automation, sustainability, things like that.
Okay, so the core model seems sound. But every great company needs protection, right? An economic moat.
Right.
What's 3M's fortress been built on?
Right, the moat. For 3M, it's primarily built on intangible assets. And that really rests on 3 pillars.
Okay, what are they?
First, a huge patent portfolio. Over 125,000 active patents globally. That makes just copying them incredibly hard.
Wow, 125,000.
Second, really powerful brand equity. Names like Post-it, Scotch, Command. They just scream quality to people. And that lets 3M command estimates are around a 7-9% price premium.
Okay, patents, brand. What's the third?
The third is their embedded innovation culture, that know-how. Historically, they fostered this with things like the 15% culture.
Right, where employees could spend 15% of their time on their own projects.
Exactly. That kind of thing built up this deep well of internal expertise and, a certain way of thinking.
Can you give us a concrete example of this moat actually working, protecting them?
Yeah, a perfect one is their traffic control materials business, road science, basically.
3M developed and patented that reflective sheeting you see everywhere.
Sure.
Well, a Japanese competitor, Seibu, came into the U.S. market with a similar product. 3M didn't just, cut prices. They went straight to their patent Moat.
What did they do?
Filed a patent infringement complaint with the U.S. International Trade Commission. The ITC ruled for 3M, and it effectively blocked Seibu's product from the U.S. market for years.
Wow.
Right up until the patent expired. So yeah, it protected a very lucrative market for them.
Okay, so clearly a strong moat, historically. But, and this is where it gets really interesting, our sources are suggesting that moat is narrowing.
Yes.
That the fortress walls are, crumbling a bit. What's going on there? What are the signs?
This is a really critical point. The most concerning sign, honestly, is declining R&D productivity.
Meaning they're spending money on R&D, but not getting as much out?
Exactly. Spending is still high, but its effectiveness seems to have dropped off. R&D as a percentage of sales, it fell from over 9% back in the 90s to less than 6% recently.
Less than 6%.
And it's just yielding less organic growth.
Yeah.
Morningstar, the investment research firm, they explicitly cited this as a key reason they downgraded 3M's Moat rating.
From what to what?
From wide down to narrow. That's a big deal.
Yeah, it is. Are there other signs pointing to this narrowing moat?
Definitely. We're seeing slower revenue growth. It's averaged just 2% annually over the past decade, which is pretty sluggish for a company like 3M.
Okay.
And margin compression. Gross margins fell. Operating margins contracted pretty significantly over the last 5 years.
So less profitable on what they do sell.
Right. And there's also been more reliance on acquisitions for growth, which often isn't as good as innovating internally. And that's contributed to a decline in their ROIC, the return on invested capital.
ROIC, right. That's a key efficiency metric.
A very key metric.
Yeah.
And it's been trending down.
Now, our sources connect this moat erosion, this R&D productivity decline, to a specific cultural shift, the introduction of Six Sigma back in the early 2000s.
Yes, that comes up a lot in the analysis.
How could a management system aimed at efficiency hurt innovation? That seems counterintuitive.
It does, but the reports from employees at the time, and even looking back, suggest the rigid, metric-heavy process the quote was, it killed initiative.
Killed initiative.
Yeah. And stifled the serendipitous discovery, that sort of unexpected breakthrough that really fueled 3M's big innovations historically.
So the focus on process maybe squeezed out the space for creativity.
That's the argument. And the declining R&D productivity we see now, it might be the long-term echo of that cultural shift.
Which raises a huge question now, right? They just hired an external CEO, William Brown. His background is all about operational excellence.
Exactly. Steeped in it.
So will his leadership free up R&D from that bureaucracy you mentioned? Or could it actually double down on systematization and maybe even speed up the moat erosion?
That is the multi-billion-dollar question, isn't it? It's a real fork in the road.
Okay, let's shift gears a bit. Let's get some scuttlebutt, from the ground level. What are actual customers and employees saying about 3M these days?
Right, the front lines. Customer sentiment. It's generally positive, but you see these worrying cracks.
Like what?
Take command strips. Everyone knows them, right? Damage-free hanging.
Yep, use them all the time.
Aggregate ratings are high. People praise the ease of use, the damage-free promise. But when you read the negative reviews, they are visceral.
Oh, really?
People reporting catastrophic failures,
Yeah.
Heavy frames crashing down, causing damage. But critically, many people note the strips took paint and plaster off the wall when removed.
Which is the exact opposite of the promise.
Directly contradicts the core brand promise. That's concerning.
Is that pattern seen elsewhere? What about something like filtrate filters? Air filters, water filters.
Very similar pattern. They get lauded for effectiveness, right? Improving air quality, water quality. People like the results.
But
a significant minority flags serious quality control problems.
like what kind of problems?
Filters being so thin, they're basically see-through. Incorrect MRV ratings printed on the package.
Sure.
Flawed design so they don't even fit properly in the furnace slot.
Oof. Not good for a premium brand.
Not good at all. So while the brands are still powerful, these consistent and sometimes severe quality complaints, they have to be a red flag for a company whose reputation is built on premium quality and reliability.
Okay, so customers see issues. What about the people inside? What's the employee vibe? Our sources suggested deep divisions.
Yeah, it really seems like a culture of contradictions. It's quite striking.
How so?
Well, on the one hand, you look at formal surveys, and they look great. 92% of employees say 3M is a great place to work. 95% say they're proud to work there.
That sounds fantastic.
Right. The famous 15% culture is still talked about, promoted. And studies show innovation is the most positively discussed cultural value. High marks for diversity, respect, too.
Okay, but you said contradictions. What's the other side of the coin?
The other side is pretty stark. You look at a platform like Comparably, which gathers anonymous employee reviews. 3M gets an overall C grade. Leadership gets a C.
Ouch, C minus.
Yeah. Only 61% of the reviews on there are positive. And the constructive feedback often points to leadership being disconnected from reality, needing to listen better. And remember that study that praised innovation? It ranked 3M terribly on agility, like 21st out of 27 companies in their industry, and performance, 22nd out of 26.
So innovative maybe, but slow and not performing?
That's the picture. Employees informally talk about being a bureaucratic cog in a corporate machine.
Which, that sounds like it ties right back to what we were saying about R&D productivity, doesn't it?
It aligns perfectly. The innovative spirit might be there in the workforce, but the corporate structure, the bureaucracy, seems to be gumming up the works, stifling execution.
Right. The system isn't letting the innovation flourish and translate into results.
That seems to be the crux of the cultural issue, yeah.
Okay, so given those internal challenges, let's look at leadership and the financials. Big changes there, too, with the new CEO, William Bill Brown, taking over in May 2024. He's an outsider, which is unusual for 3M, right?
Very noteworthy, yeah. They usually promote from within.
So what's his philosophy likely to be? What's he bringing?
Well, his background is at places like L3 Harris Complex, industrial, defense firms. It points to a core expertise in operational excellence, rigorous execution, strategic leadership.
Less about inventing the next Post-it note, more about making the trains run on time.
That seems to be the emphasis, yes. His initial statements focus on growth, operational excellence, and capital deployment priorities. It feels less about fostering that serendipitous invention and more about making sure this huge industrial machine runs efficiently and, crucially, manages its huge liabilities.
Speaking of managing things, let's look at capital allocation. Our sources analyzed recent moves, mostly under the previous leadership, but setting this stage. What stands out?
The biggest and probably most rational move was that spin-off of the healthcare business into Solventum.
Right.
The stated goal was clear. Create 2 more focused companies, unlock value for shareholders, and importantly, 3M kept a 19.9% stake in Solventum.
Why keep the stake?
They plan to monetize it, sell it off within 5 years. That provides a pretty significant chunk of future capital. Think of it as a financial bridge to get them through the next few years.
Okay, that makes sense. What about returning cash to shareholders? The dividend. 3M's famous for being a dividend king. Decades of increases.
Yeah, legendary status for income investors. They've returned billions that way.
But that changed, right?
It did. After the spinoff, management announced a new dividend policy. They essentially rebased it.
Meaning cut it.
Well, reset it. The new target is about 40% of adjusted free cash flow, which is, yes, lower than before.
Why do that? Risking the dividend king status.
It's a really prudent move, even if it hurts for some investors. It's an acknowledgement first that the company is smaller now without healthcare. But more importantly, it recognizes the massive cash payments coming up for those big litigation settlements.
PFAS and the earplugs.
Exactly. They need the cash for that.
Yeah.
So this prioritizes the health of the balance sheet over maintaining that dividend streak at any cost.
So putting it all together, the spin-off, the dividend reset, the operational focus. What's the verdict on 3M's financial health, their financial fortress?
Well, historically, 3M was an earnings machine, just churned out strong, consistent profits. That reputation, definitely tarnished now.
Because of the litigation?
Primarily. Their official GAAP results for 2023 showed a mind-boggling negative $7 billion net loss. That was all due to booking charges for the litigation.
But is the underlying business still profitable?
Yes. If you look at their adjusted results, stripping out those massive one-time charges, the core business remains highly profitable.
Okay. What do the key financial quality ratios tell us, like ROIC?
Right, return on invested capital. Historically, it was excellent for 3M, often over 20%, which is great.
But
the trend is clearly negative. It peaked around 31% in 2018 and fell to about 26% recently, even before the big litigation hits. That decline, as we said, was a key factor in Morningstar's Moat downgrade.
Okay, so ROIC trending down. Anything looking better?
Yes, one area where they remain exceptional is free cash flow conversion.
Meaning they turn their reported profits into actual cash very well.
Exactly. They consistently turn 90, 100%, sometimes even more, of their net income into real cash. That indicates high-quality earnings.
Yeah.
And their balance sheet, traditionally measured by net debt to EBITDA, has been pretty conservative.
But I sense another but coming.
There's a huge caveat, absolutely. While the balance sheet looks okay on paper today, those massive multi-year cash payments for the PFAS settlement, that's $10.3 billion.
$10.3 billion?
And the Combat Arms Earplug settlement, another $6 billion. Those payments are going to act just like debt service.
Draining cash for years.
For years. It will severely pressure the company's finances. So you have to view that balance sheet strength metric with extreme caution right now.
So the capital allocation is basically in triage mode.
That's a perfect way to put it. Triage phase. It's constrained by these huge non-negotiable payouts. And that planned sale of the Solventum stake, that's not just extra cash, it's a critical capital bridge to help them get through this.
Okay, so given all that, the Moat issues, the financial pressure, the new leadership, let's talk valuation. Is 3M stock a good buy at its current price?
Well, our analysis suggests the current price looks maybe fairly valued, but, and this is key, it doesn't seem to offer an attractive entry point if you're a long-term investor looking for a margin of safety.
Why not? What's the market pricing in?
It seems like the market is already assuming a pretty smooth operational turnaround under Bill Brown, and assuming the litigation outcome is manageable, that the settlements are basically the end of it.
Leaving little room for things to go wrong.
Exactly. Not much room for error or any negative surprises. Morningstar, for instance, actually sees this stock as trading at a significant premium to what they think it's intrinsically worth.
Okay, so maybe not a bargain. Looking ahead, what is the main growth engine supposed to be for the new, leaner 3M? Where will future earnings growth come from?
The most important driver, really the only path back to strong growth, is 3M successfully applying those core material science platforms to win big in secular growth markets.
Like what specific?
Management points to automotive electrification. Remember, that grew 30% recently.
Right.
Also industrial automation and sustainability or renewable energy. Hitting it big in those areas is critical if they want to grow faster than the overall economy and command better margins. But again, that requires the innovation engine to be firing.
Which we've established is questionable. So what are the biggest risks that could permanently damage 3M, the things that could really derail the whole story?
There are two really big ones, I think. Permanent impairment risks. First is unmanageable litigation liabilities.
Meaning the current settlements aren't the end.
That's the fear. While the big PFAS $10 3B and Combat Arms $6B settlements are announced, the huge risk is that more claims pop up, or the current deals somehow unravel. That could force devastating cuts to R&D, maybe force them to sell off core assets, or even, worst case, threaten solvency down the road.
Okay, litigation uncertainty. What's the second major risk?
The second is the terminal decline of the innovation moat. We've concluded the moat is already narrowing. If the new CEO's focus on operational excellence accidentally smothers the creative culture even more, or if they have to cut R&D too deeply because of the litigation payments, 3M could just slowly devolve, become a collection of slow-growing, maybe even commoditized businesses that would permanently impair its earning power.
It really sounds like the market is hanging a lot on this strategic reset and the new CEO, doesn't it? How is the market generally viewing 3M right now?
Yeah, the prevailing narrative is definitely this. 3M is a kind of beleaguered industrial giant. It's at a critical turning point.
Okay.
The consensus acknowledges the historical quality, the good bones, but is deeply worried about the litigation overhang and, past operational stumbles. Most analysts have it as a hold or neutral.
But the stock has moved up from its lows, hasn't it?
It has, which suggests there's a growing group of investors who think maybe the worst is over for litigation and that the new CEO plus the Solventum spinoff will create a leaner, more focused, more profitable company.
Okay, that's the consensus view. Now, here's where we do the deeper dive, the second level thinking. Yeah. What's the contrarian view? Where might the market be getting it wrong?
Our analysis points to something crucially different. The market seems to be underestimating the long-term structural damage to 3M's innovation-based economic moat.
Underestimating the moat damage?
Yes. While at the same time, potentially overestimating how easy it will be and how much impact a purely operational turnaround can have.
So the market sees the new CEO and the restructuring as the fix.
Right. They see it as the solution. But we tend to view those things as necessary, absolutely, but maybe not sufficient to get 3M back to being a truly wonderful company.
Because the core issue is deeper.
Exactly. The core issue seems to be that erosion of R&D productivity, the potential damage to the creative culture.
Just fixing margins and simplifying the structure doesn't automatically bring back the magic that let 3M invent whole new product categories out of thin air.
So the market's focused on the financials, the structure.
While the most important long-term variable might actually be the health of those intangible assets, the innovation engine, the brand reputation for quality, which seem weaker than the consensus might appreciate right now.
Okay, let's try to bring this all together for you, the listener. The bull case for 3M seems to rest on this strategic reset, right? New, operationally savvy CEO, a still durable product portfolio that's deeply embedded everywhere.
Plus that massive free cash flow generation, which could be redeployed once the litigation payments ease up. And the hope that the worst of the legal headwinds are indeed behind them.
But the bear case puts up a strong fight. That eroding economic moat because innovation is sputtering. A balance sheet that's basically going to be in triage mode for years paying off those settlements.
Right. Plus that deep-seated cultural issue, the lack of agility, and frankly, an unattractive risk-reward profile at the current stock price.
So to challenge your thinking even more, as we like to do, what's the most compelling argument for why buying 3M today could turn out to be a major long-term mistake?
I think it's if 3M turns out to be a classic value trap.
Meaning it looks cheap, but it's cheap for a reason.
Precisely. What if the new CEO, the new structure, they simply cannot fix the fundamental problems? What if that main growth engine, applying material science to new trends like EVs, what if it fails because the R&D culture is just broken and maybe can't be repaired easily?
What if that impressive 30% growth in automotive electrification we mentioned turns out to be just a one-off success, an isolated bright spot in a sea of general mediocrity, not proof the engine is fixed?
Exactly. And what if the moat isn't just narrowing? What if it's actually already breached? With 3M's huge portfolio just getting slowly picked off product by competitors who are more focused, more agile.
And what if those quality complaints we heard about the command strips ripping off paint, the Filtrete filters being flimsy, what if that's the canary in the coal mine? Signaling that the whole premium quality brand promise, the foundation of their pricing power, is becoming hollow.
And the ultimate nightmare scenario. What if these multi-billion-dollar settlements aren't the end? What if new waves of claims emerge that dwarf these amounts? Then that triage phase for capital allocation never ends. Future profits just get eaten up by legal costs forever instead of going to R&D or back to shareholders.
In that scenario, the company just never gets its momentum back, and you're left holding what looks like a melting ice cube, potentially bought at a premium price.
It's a sobering possibility.
Definitely a lot to chew on there. What stands out most to you from this deep dive? We really encourage you to keep digging into these questions yourself. Thanks for joining us for the deep dive.